take you through this part. Net present value, the adjusted net present value. The net present value, it is an area that can equally be tested. And I want us to move through it very fast before we can move to the other things. Look at this. Adjusted NPV. Can you see my screen? Let me know. Can you see my screen? Let me know whether you can see my screen. The turnover is still low. Someone is saying that is asking whether I'm okay. Maybe I'm so tired, but I'm okay. I'm okay. Thank you. I'm very okay. Someone is asking if possible, say anything about APV. That is where we are. That is what I planned. Yes, thank you. I can see someone asking, we are ready, but if possible today, say anything about APV. Yes, yes, yes. That is what I'm starting with. You sound like someone who is sick. No, I'm okay. I'm okay. I'm well. It's only that I have been very busy. And again, I was watching the Kenyan football team as I was waiting for you face Madagascar. Madagascar is giving us hard time. We are so far 1-1. We scored 1, they scored on our side 1. So they are putting pressure on us. Yeah, thank you. So let us start. I want us to look at the APV. Someone has asked about APV, and that is what I'll start with, because I had also planned about it. We call it APV or ANPV. So if you can see my screen, I want us to look at the adjusted net present value or adjusted PV. So the adjusted present value method is the project appraisal technique used when the conventional net present value approach is not appropriate. While the conventional NPV method discount all cash flows using the company weighted average cost of capital, the value of the financing effect. This method is particularly useful when the project financing structure differ from the company existing capital structure. So when we use the adjusted PV, the adjusted present value, also known as the adjusted net present value, we say that the conventional net present value analysis assume that the financing of the new project will mirror the company's existing capital structure. However, this assumption isn't always valid. The adjusted present value method is the most appropriate technique for project appraisal in the following situation. When do we use the adjusted present value instead of the net present value, the one we have been discussing? Number one, in case of different financing structure. That is, the financing structure for a new project deviates significantly from the company target capital structure. For example, a project may be financed with 80% debt and 20% equity, or the company optimal capital structure is 60% equity and 40% debt. We evaluate the project under APV where the capital structure of the firm is not the one that is used to finance the new project. Maybe you have the capital structure with 60% equity and 40% debt. But when you are undertaking a new project, you borrow 80% of the capital to finance the new take the new project, and you only that financing structure is different. So in such a case, the conventional net present value may not be appropriate. That is number one. Number two, scenario number two, a project is partly financed with the where the interest rate is below that is the subsidy that need to be valued separately. What does this mean? It means that you want to raise debt, let's say 100 million Rwandan francs. Out of the 100 million, you are told that 60 million you will be given by the government at maybe 5% interest. The other 40 million you borrow from the bank at the normal interest rate, maybe it is at 20%. So there is a 60 million that is subsidized. The cost of debt is subsidized. That is the scenario number two in case of subsidized debt. Number three, in case of varying discount rate, different cash flows generated by the project should be discounted at different rates due to varying risk level. We say that when you are discounting the cash flow, you find that different cash flows are discounted at different discounting rates. For example, you may undertake a project and the first 5 years of the project life are not risky. If the project is like 15 years, the remaining 10 years are very risky. You discount the first 5 years at a low discounting rate and the last 10 years at a high discounting rate. The other issue is in case of complex tax structure, the project involves complex tax considerations such as tax holiday for a specific number of years. There are projects that the government want to promote and they give you tax holiday, meaning some years of the project you will not pay tax. Some other years you will pay tax. So there of the project life or initial capital. We know that the capital invested in a project is subjected to depreciation or what you call the capital deduction. So such capital allowance is expected to be provided on the full value of the asset. In case the value of the asset is not fully fully provided with the capital allowance, maybe 80% will be allowed and 20% will not, then it means you cannot use the conventional net present value approach. So these are the circumstances that the adjusted present value will be preferable to the conventional and adjusted present value. Let's look at this, calculating the adjusted NPV or the adjusted present value. The NPV is calculated by adding the present value of the project financing side effect to its base case NPV. The base case NPV, this part, is the NPV of the project, assuming that it is fully financed using equity. So we use the cost of equity as the discounting rate. That is called the base case NPV. Then you add the present value of financing side effect. And this is the way to go about it. Number one, determine the base case NPV. This is the NPV of the project, assuming all equity financed. That is, it is ungeared. The cash flows are discounted using unlevered cost of equity. Cost of equity for ungeared firm, you can calculate the cost of equity for ungeared firm using the capital asset risk-free rate plus expected return of the market minus risk-free rate multiplied by the beta factor for equity. The unlevered beta can be derived from the levered beta using the Modigliani and Mira. We discussed about that. We said that beta of equity for unlevered firm is equal to 1 plus D over equity subjected to 1 minus tax. You multiply by the beta of equity for a geared firm. That is number one. Determine the base case NPV. Number two, determine the present value of the subsidy. We say that subsidies are benefits that are awarded by the government. So we say that the subsidy arising from the reduced interest charges on a subsidized loan, since the subsidy is a guaranteed cash flow, when you are subsidized by the government, we assume that it is a guarantee by the government. It is discounted using the risk-free rate. So step number two, determine the present value of the subsidy. Number three, determine the present value of the interest tax shield. We say that the interest tax shield is a benefit arising from the tax deductibility of interest expense. So we say that the interest tax shield is equal to interest times tax rate. So as long as the firm is financed using debt, the interest tax shield will be enjoyed. It is therefore guaranteed, and therefore it is discounted using the risk-free rate. So step number three, determine the present value of the interest tax shield. Number four, determine the present value of the issue or the flotation cost. We know that the flotation cost is incurred when you are undertaking the project. We say that at year zero. So we say that it is already in its present value and therefore no discounting that is needed. Once you have determined that, we calculate the final adjusted NPV, and we say that adjusted PV is equal to the base case NPV plus present value of the subsidy plus present value of interest tax shield minus present value of flotation cost, because it is a cost. So a project is accepted if APV is positive, and it is rejected if APV is negative. So that is the argument that we have when it comes to the issue of the new method or this method of the APV in project evaluation. So anytime that you're evaluating the project and you are faced by those scenarios, it is good to use the APV. And very fast, I want to explain this using a small illustration here, so that at least we can understand before we move to the past paper questions. Look at this question. The question, we are told that the managers of Kawaida Limited are investigating a potential Rwandan funds 25 million investment. The investment would be diversification away from the existing mainstream activity into food manufacturing industry. Rwandan francs 6 million of the investment would be financed by the internal funds. Rwandan francs 10 million by a right issue, and the Rwandan francs 9 million by long-term loans. The investment is expected to generate a before-tax net cash flow of approximately 5 million per year for a period of 10 years. The residual value at the end of the 10-year is forecast to be Rwandan francs 5 million after tax. As the investment is an area that the government wishes to develop, a subsidized loan of Rwandan francs 4 million out of the 9 million is available. This will cost 2% below the cost of the normal cost of long-term financing, which is 8%. Then we are told that Kawaida Limited equity beta is 0.85, and its financial gearing is 60% equity and 40% debt by value. The average equity beta in the food manufacturing industry is 1.2, and the average gearing is 50% equity and 50% debt by market value. The risk-free rate is 5.5% per annum, and the market return is 12% per annum. Issue costs are estimated to be 1% for debt financing, excluding the subsidized loan, and 4% of equity. These costs are not allowable. Then we say that the corporate tax rate is 30% required. Determine the adjusted present value. Determine the adjusted PV. I want to use this question to explain the adjusted PV. We look at it together. I want to display the entire question here so that at least you can see it. Let's look at this question. Okay, can you read through the question? It is on the display, please. Please read so that we can solve it together. Just read 1 minute. This question together, we see what would be expected of us. We are required to determine the APV. So the question, if I could read through it very fast, the question reads, the managers of Kawaida Limited are investigating a potential Rwandan francs 25 million investment. The investment would be diversification away from existing mainstream activity into the food manufacturing industry. Rwandan francs 6 million of the investment would be financed by internal funds. Remember, we require 25 million. So 6 million will be financed using internal funds, 10 million by rights issue, and 9 million by long-term loan. So in total, 6 plus 10 plus 9 is 25 investment. The investment is expected to generate the before tax net cash flow of approximately Rwandan francs 5 million per year. That is pre-tax net cash flow of approximately 5 million per year for a period of 10 years. The residual value at the end of the 10 year is 5 million. That is the residual value after tax. As the investment is in the area that the government wishes to develop, a subsidized loan of Rwandan francs 4 million out of the 9 million loan is available. This will cost 2% below the company's normal cost of long-term finance, which is 8%. So it means that out of the 9 million, 4 million will be given by government at a lower interest rate. Kawaida Limited equity beta is 0.85 and its financial gearing is 60% equity and 40% debt by value. So the current capital structure of this firm is 60% equity and 40% debt. The average equity beta in the food manufacturing industry is 1.2, and average gearing is 50% equity and 50% debt by market value. This company is venturing into a new industry whose capital structure is 50% equity and 50% debt. Then we are told that the risk-free rate per annum and the market return is 12%. That is, the risk-free rate is 5.5 per annum, 5.5% per annum, and the market return or the expected return of the market is 12%. We are told that the issue costs are estimated to be 1% for debt financing, excluding the subsidized loan, and 4% for equity financing. These costs are not allowable. Then we are told that the corporate tax rate is 30% required. Estimate the adjusted present value of the proposed investment. In this case, I will do step one, and in step one is determine the base case net present value. We call it the base case NPV. This is the NPV. This is the NPV, assuming that the project, assuming that the project is all equity financed. Equity financed. You assume that the project is all equity financed. That means if the project is all equity financed, it means that the project cost of the cost of capital is or simply the discounting rate is the cost of capital, is the cost of equity, rather, is the cost of equity. So in our case here, we need to establish the variables that we use, and this one we discussed yesterday and the previous time. We say that initial capital is equal to Rwandan francs 25 million. That is what we are given. Then we determine the salvage value. Value is equal to Rwandan francs, the Rwandan francs 5 million. The Rwandan francs 5 million. Then we need to determine the cost or the discounting rate. Discounting rate. There is something you look at here. This part, let me put from here. From here, the highlighted part, we say that Kawaida Limited equity beta is 0.85 and its financial gearing is 6% equity and 40% debt by value. So the beta factor is 0.85. The average equity beta in the food manufacturing industry is 1.2, and the average gearing is 50% equity and 50% debt. Now, there are two things. There is the beta factor of Kawaida Limited, and there is the beta factor of the industry, food industry. Which beta factor do we use? I want to hear from someone. Do we use the Kawaida Limited equity beta of 0.85 or the food industry beta factor of 1.2? Let me hear that from someone, because these are the questions that you need to make a good decision in an examination. Do we use the industrial beta or we use the company beta factor? I see the responses: industry beta. Did someone ask something that I see someone is telling us that Madagascar is going to beat us. Sorry, let us wait. They should be finishing. That is what people believed even in Morocco, but we beat them. That one I'll give you the answer before we finish. Okay, let's go back to the question. So we are saying that food beta, industry beta, food industry, because we are investing in food industry, industry beta. All people are in agreement that it is industry beta. That one I knew. It would be an issue to choose. Let me see from the other case. Everyone has said industry beta. Industry beta. Everybody has said industry beta. I say no, it is not industry beta. Understand this question. Who is investing? You invest based on your costs. Let me ask you a question. If you are in Rwanda, you go to your bank, you borrow a loan, and you are given the loan at 20%. Then you take that loan to Kenya. You take a 5 years project. You borrow a loan at 20%. You are the one investing. You go to Kenya. You invest in a 5 years project. But when you get to Kenya, you realize that the loans, the banks in Kenya are giving loans at 15%. And you are investing in Kenya, the Kenya loan interest is 15%. But for you, the money that you will invest, you borrowed in Rwanda at 20%. Simple question. When you are evaluating your project, will you use the interest rate in the Kenyan market where you are investing, or will you use the interest rate from where you borrowed the money? Just answer to me that question so that we agree. You are in Rwanda, you borrow loan at 20%. You have a project in Kenya. But when you go to invest in Kenya, you find that the interest rate for the banks in Kenya is 15%. Already you have borrowed, you want to invest. Will you evaluate your project using the interest rate in Kenya or the interest rate on the loan that you borrowed? Someone to respond to that question. Which interest rate will you use? Is it the one from where you borrowed or from where you are going to invest? Someone says that you will evaluate based on you borrowed the amount. I think the interest rate from where you borrowed the money. Where you borrowed 20%. Yes, that is the same argument. Here, this company wants to invest. Their beta is 0.85. They are investing their money. They are not investing the money for the industry. In that industry, the beta factor is 1.2. But whose money is being invested? Are they investing the industry money or they are investing their money? So the company is investing its own money. And as a result, it should not use the interest rate of the industry. It will use its own interest because it has its own money. That is the cost of capital, the cost of equity. This company has its own money. It is its own money that is being put into the project. So for all the purpose of responding, I will disagree with all the answers that you have put. But the good thing is, tomorrow you will remember is that you are evaluating with your money because you are investing your money. Are we together? I want to know whether we are together because that one I knew it would cause a problem. I hope we are together that we are going to use the investing company cost of equity. And therefore, let us determine the cost of equity. We say that cost of equity that is ungeared is equal to risk-free rate plus the return of the market minus the risk-free rate. This one we multiply by the beta for equity, of the ungeared beta, the beta of equity for this firm, So let me put it here like this. So back to the question up there, we are told that Kawaida Limited equity beta is 0.85 and its financing gearing is that and that, debt by value. So the beta factor, the average equity beta in the food industry is 1.2. So we need the beta factor for this equity, the equity that will be used. We say that it is equal to the cost of equity is equal to risk-free rate is 5.5. This one we plus the return of the market is 12. This we minus 5.5. this we multiply by the beta of equity. It is 0.85. And how much is the cost of equity? How much is the cost of equity? Someone to give me that. And I hope you understood that. Let me the answers that you are giving, please. Someone is asking, when do we use the industry beta? If we are using the financing of the industry beta, but in this case, we are not using the financing of the industry beta. We are using the financing of the company. The company is the one that is financing. So unless we are told that they will use the financing of the industry. So how much is the interest rate, please? Let us see. Let us see. I see one person has responded, 11.0025. I don't know whether that is correct. Let's see how much is this? 11.025, like that. Let me give it this way, that way. Now, if that is the case, we determine the annual cash flows. Annual cash flows. What are we told about the annual cash flows? Somewhere we are told that if you looked at this part of the question, this part, we are told that the investment is expected to generate a before-tax net cash flow of approximately 5 million per year for a period of 10 years. So we need to establish what is the cash flow that will be generated by this project. We are given the earnings before depreciation and taxes of 5 million. We need to subject it to the tax, then we determine the annual cash flow. So for us to go about that, let's go down here. Annual cash flow, we say that we have the earnings before depreciation and taxes. This is equal to 5 million less depreciation. The depreciation of this project, we are told that they are investing 25 million, but they have a salvage value. I don't know whether we are given the salvage value. Is there salvage value somewhere? Yeah, the residual value at the end of the 10-year is the forecast to be 5 million. It's 5 million. So unless otherwise provided, we assume a straight line depreciation method. You divide by 10, then that one is equal to how much? So can someone give me this? How much is 25 divided by 5 minus 5 divided by we divide by 10. Let me see. 2 million. Yeah, we have the 2 million. We have the 2 million. So we'll have minus 2 million. 2 million like that. This is the earnings before taxation. The earnings before taxation is 3 million less tax. The tax rate is given as 30% tax. This should be equal to, I think it is 900, like that. Then that is earnings before taxation. This is 2.1 million, and before tax, add back depreciation. Add back depreciation. The depreciation is, oh, how much was it? It is 2 million. This is the annual cash flow. The annual cash flow, and this is 4.1. 4.1 million is the annual cash flow, the cash flows that will be realized in each of the years. Remember, we can give the annual cash flow a different approach. We also need to note this. I can give this one as a note. Annual cash flow may also be determined by the earnings before interest and tax. You multiply by 1 minus tax, then you add depreciation tax shield. And we say that depreciation tax shield is equal to depreciation per annum multiplied by tax rate. So can we therefore say that annual cash flow is equal to the earnings before depreciation and tax, 5 million. We multiply by, open a bracket, 1 minus 0.7. Then this one we add, depreciation is 5 million. Oh, sorry, depreciation was 2 million. Then this one we multiply by tax rate, 0.3. Can someone put this in the calculator and tell me how much would be depreciation, earnings before depreciation and tax, multiplied by 1 minus tax. Tax is 0.3. Someone to give me the answer to this one, please. Is it 4.1? It should be the same. If the computation is correct, we should arrive at the same answer. That is 4.1 million. So the annual cash flow is equal to 4.1. So in case you are told to determine, you can use that. So then from there, determine the NPV, and we can say that present value of annual cash flows is equal to 4.1 million. We multiply by the discounting factor, which is 1 minus 1.11025, 11.025% power negative 10 years. Then whatever you get there, you divide by 0.11025. I think it should be that way. So this is the discounting factor. It will give us the annual cash flow, the present value of the annual cash flow. You add the present value of salvage value, the present value of the salvage value, which is equal to 5 million. You multiply by 1.11025, power negative 10, This one will help us to get the present value. So let's get the present value of the annual cash flow. Can I get the present value of the annual cash flow, please? Present value of the annual cash flow. How much is it? How much is it? Uh, someone is giving 24 1 2560.2 given. So I'll put a present value of the terminal cash flow. 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 Let me see. Present value of salvage value of the terminal cash flow. Someone has given 1756,961. 1756,961. Like that. Then we can say that total present value. Total present value cash inflow. Total present value of the cash inflow. Someone to sum them up, please. Sum them up. Sum this up. Sum them up and give me the amount. Someone to give me this, please. Do I have 25, 877, 821? Yeah, I think there are two individuals. Like that. We less initial capital. The initial capital. This is 25. We minus the initial capital. Minus the initial capital. Then whatever we get is the NPV. This one should be 877, 877, 521, 521, 0.5 I think, 0.5 I think. This is the NPV. That is the first thing, you determine the NPV. So the first thing to determine is to determine the NPV. And there is someone who asked a question yesterday and which I need to answer today, because I know that question will be asked by someone, or someone expects that I should have responded to that question. It is important. Someone asked a question: what are the tricks to passing exam? That is a hard question and a simple question at the same time. It is a hard question and a simple question at the same time. And I want, how do you get, someone asked that question, how do you get to Nairobi from Kigali? There is someone who will tell you, from where you are, take a taxi, go to Kigali airport, take your freight from Kigali airport to Nairobi Jomo Kenyatta. Once you get to Jomo Kenyatta, Nairobi, you take a taxi to the city. That description of getting to Nairobi from Kigali is correct. Another one will tell you, go to the stage, take a bus, board a bus, go to Nairobi. It will take you to Nairobi. Another one will tell you, by the end of those people explained how you get to Nairobi from Kigali. Yes, they have explained. The only thing is they have used different routes to getting to Nairobi. Now, the thing is, once you are given the three options, you cannot use a bus to Nairobi at the same use you walk and at the same time you use a freight. You will have to take one route to Nairobi. There is no way you can get to Nairobi at the same time using the three options. You want to walk, you want to use a bus, and you want to use air. You must take one. And when you take one, just stick by that. You will get to Nairobi. The same case when you are taking any unit. Can you take a certain source and stick to it? Why do I say that? Today, there are so many sources of learning material. I will teach you, I will give you my way to passing and to understanding a concept. Another person will go to AI, you will seek, and the AI will give you a way to getting an answer. Another one will get a textbook, you will read, and you will get a way to getting an answer. The objective of all those ways is to help you understand the concept. Now, this is where the student have a problem. You have about 5 sources. I will teach you, you take my formula, you go to Google, to confirm, you get a different formula. You go to AI, you get another one. You go to the library, you get a textbook, you get another formula. I don't have a problem with that, but can you stick on one? Because there is no way you can apply 5 sources in different argument in an examination. That is my first advice to passing an exam, meant to help you understand. It is meant to help you. I am also not to help you, you get the concept and you pass the exam. When you take all of them, in the exam you are asking yourself, which one is better, which one is not good? Just take one. Stick by one and go by that. Because the argument to solving problem, there are so many. And a good example, if you went and found a solution, a question that is solved, a simple example like what we have just done. Someone has given you the annual cash flow, computing using these steps. Another one, in another book, you find that the cash flow have been computed like this one. By the end of the day, you are using different figures, but you arrive at an answer. You don't need to use both of them. Just take one, forget about the other one. Because I've seen students, like now, I have just seen someone who has sent me a textbook. I see someone has sent me a textbook, and I believe this is a book someone has solved in another way or a different way. If I am going to get to this one, then The person who solved that problem did not mean to mislead you. They meant well. But when you take as a student, you take so many sources, you might end up being confused. So either stick by what I'm giving you or what you get from Icpar. Read other books, but in case of confusion, just take what I'm giving you or what you get from the Icpar notes. That is what I would advise, because there is a million and one way to getting a solution. I don't dispute that any is correct or any is wrong. But what I'm saying is that you might end up being confused. You find yourself in the exam, you know a lot, but you cannot answer a question. So just do your research, but when you adapt, out of the many ways that you see, stick in one. Don't confuse yourself. Remember, you don't have a time to confuse yourself in the exam. The exam is either you sit and pass or you sit and you repeat. So please do your research, but please don't confuse yourself. Don't confuse yourself. You might, whatever the method that you take, just stick to it. That is what I would advise you. We will be discussing other issues about how to go about it. Now, the next step, let us determine the present value of interest tax shield. Determine the present value of interest tax shield. Determine the present value of interest tax shield. The interest tax shield, we said, is guaranteed. When I go back to the question, I see the interest. Let me see the loan. We are told that the investment is expected to generate, not that. We are told that the investment would be diversification away from the existing mainstream activity into the food manufacturing industry. 6 million of the investment would be financed by internal funds. That is Rwandan francs 10 million, rights issue is 9 million, and long-term borrowing of 9 million. The investment is expected to generate a pre-tax of that. There is somewhere we are told that as the investment is an area that the government wishes to develop, a subsidized loan of Rwandan francs 4 million out of the total 9 million is available. 4 million out of the total 9 million is available. This will cost 2% below the company's normal cost of long-term finance, which is 8%. So I need to determine the interest tax shield. Determine the present value of interest tax shield. We say that interest tax shield is equal to interest multiplied by tax rate. How much is the interest? Interest is equal to, out of the 9 million, there is that portion that is financed by the government. We are told that as the investment is in an area that the government wishes to develop, a subsidized loan of 4 million. So the 4 million will be charged at 6%. So we have 4 million. You multiply by 6% because we are told that it will be charged at less by 2%. Then the remaining 5 million will be charged at 8%. How much is the total interest? How much is the total interest? Let me get the total annual interest from someone. How much is the interest? How much is the interest? Interest. It said 640. I see someone is giving us 640. 640, is it? Yeah, 640,000. That is 640. 640, like that. Then we say interest tax shield is equal to 640 times tax rate. So how much is the interest tax shield, the interest tax benefit? The interest tax benefit. Someone. 30% of 640. $192,000. I see someone giving 192,000. 192,000. So do I go by that? 192,000. Interest tax shield, 1,000. Then present value of interest tax shield. The present value of interest tax shield, this one will be done annually, 192. We multiply by minus 1.0. This one should be 1 power negative 10 years. That way, close the bracket, divide by 0.055. This will give us the present value of the interest tax shield. How much is that? How much is that? Can I get how much is it? Let me get the present value, please. Someone has given me, he said 47 to 24. Can we confirm? Let us confirm that. Let's confirm, please. So I'll pick what I'm given. Yeah, I think it is confirmed. So that is the present value of the interest tax shield. Like that. Then determine the present value of subsidy. The subsidy is guaranteed by the government. It will have to be given. Determine the present value of the subsidy, like that. How much is the subsidy? We are told that it is by less by 2% multiplied by the financing by the government. We are told that subsidized loan of Rwandan francs 4 million. So 2% of 4 million. 2% of 4 million. How much is the present value of the subsidy? Two percent of the subsidy. Yeah, I think someone is asking about the 5.5%, and I can see there are people who have responded. That one I explained very well that we use the risk-free rate. Someone who is saying that the subsidy is, we need to understand this. The lesser amount that you pay, that amount, the less you are given a subsidy. So the subsidy is that difference between the market rate and what you are paying for the government. And if you can for the loan, if you can look at this question here, for those who are asking about risk-free, is that the risk-free rate is 5.5% per annum. The other part is the part of the subsidy we are given here. We are given the subsidy here as the investment, this part. As the investment is in an area that the government wishes to develop, a subsidized loan of 4% out of the total 9 million, or 4 million out of the total 9 million is available. This will cost 2% below the company's normal cost of long-term financing. 2% is the subsidy. So can we go by this? How much is this? 2% of the 4 million. 80,000. Yeah, I see someone say 80,000. 80, like that. Then we say that present value of subsidy. Present value of subsidy is equal to 80. We multiply by 1 minus 1 point. Subsidy is guaranteed. 1.055. So you discount it using the risk-free rate because it is guaranteed by the government. Minus 10. This one you multiply by, you divide by 0.055. Then that one will give us the present value of the subsidy. How much is it? Someone to get the present value of the 80,000. Someone says 603, 610. Can we confirm? I have said multiple times that the subsidy is guaranteed, so it is risk-free. The interest shield, as long as there is debt and tax, interest tax shield is guaranteed, so it is risk-free. It doesn't have any element of risk. They are risk-free. I see 603, 010. 0.0663. I think that is what I see. So I'll have it here like that, 603, present value of, then we determine the present value of flotation cost, the issue cost. So we say that issue or flotation cost is in its present value since it is incurred in year 0. It is incurred in year 0. So we say flotation cost is equal to, let's go back to the question. We go back to the question whether we have the flotation cost. We are told that here, this statement is not relevant. We are told that the risk-free rate is 5.5% per annum and the market return is 12% per annum. Issue costs are estimated to be 1% for debt financing, excluding the subsidized loan, and 4% for equity financing. Let's go to the equity financing. Just allow me 1 second. I respond to a question. Interference. I can see someone saying, someone says that there is something I've seen a percentage. Someone is saying, me, I think 80% minus 2% is 6%. That is the interest rate that will be charged by the government. But the subsidy is 2%. Subsidy is 2%. There is no way we can take 6% to be the subsidy. 6% is the interest that will be charged by the government. But subsidy is 2%. I know someone, there could be some misunderstanding, but anyway, the subsidy is 2%. Okay, let us continue. Now, where were we? Let me see. The flotation cost. Oh, I was explaining the flotation cost. The flotation cost, we are told that this part, the investment would be diversification away from existing mainstream activity into the food manufacturing industry. 6 million of the investment would be financed by the internal fund. Internal fund, that is retained earnings. 10 million by rights issue and 9 million by long-term loan. Then at the bottom here, we are told that there is somewhere at the very bottom here, the issue costs are estimated to be 1% for debt finance, excluding the subsidized loan, and 4% for the equity finance. Can you give me the total financing costs Considering that statement and considering the question up there, just look at the question, give me the flotation cost. Someone to give me the flotation cost. What is the flotation cost? What is the flotation cost? How much is the flotation cost? I need, you can read through that question. Give me the flotation cost. How much is it? How much is the interest? How much is the, not the interest? How much? I need the amount. Give me the amount. How much is the amount of the flotation cost? How much is the total flotation cost in amount? Someone is giving 467, another one is giving 250. I need to see how much you have. From the question, how much is the issue cost or the flotation cost? I can see 450, I can see 467. I see that is 290, 467. I need to know how much is it? How much is the flotation cost? Look at the question and tell me. 290, 290. Let me see the flotation cost. I only see two answers, the 467 and 290. I want you to give me the flotation cost. How much is it? You can see the question. Can you compute it? For 16. So how much is it? I only see about 3 people who have responded. Then when I compute, you start saying, oh no, it is this, it is this. Can you compute? Can you compute from what you see in the question? So let us work on it together. We determine the flotation cost. From what we have in the question, we are told that issue costs are estimated to be 1% for debt finance, excluding the subsidized loan, and 4% for equity. In the question, we are told that 6 million of the investment would be financed internally, that is equity, 10 million by rights issue, that is equity, and 9 million by long-term finance. So we take the 4% of 10 million. This one, 9 million is the debt, but we are told to exclude the one on the subsidy. So we are supposed to get the flotation costs this way. This one, we say that 4% multiplied by the right issue. This one, we add 1%. You multiply by 1%, you multiply by the debt excluding the subsidy. How much is 4% of 10 million, which is the rights issue? You add 1% on the debt, which excludes the subsidized loan. Let me get the amount here. How much is it? How much is that? How much is this? Is someone giving 450? I see a 450. 450. So I think it is 450. What I can see, a majority have given 450. So the flotation cost is 450. can hear me? Can you hear me? Can you hear me? Okay, I don't know what had happened. If you can hear me, it's okay. Can you see my screen? Is my screen visible? If my screen is visible and you can hear me, give me the APV, the adjusted present value. Give me the adjusted present value. Give me the adjusted present value. Or you are saying that you lost me at the flotation cost. The flotation costs. This does not attract flotation costs. So it gives a let me know whether you can hear me now, please. Okay, I see you can hear me. I see you can see my screen. Okay, thank you. Let's see how much is the APV, if you can see it on the screen. I need to get the APV, this one. Give me the APV from this, please. Adjusted present value. Get me the adjusted present value. PV. Someone says that the PV of the subsidy is not correct. How much was the PV of the subsidy? I think was this a point something? 603,010.066. This PV of the subsidy. I think this one must have been a point. Can you confirm that this PV of the subsidy, someone says that it is not correct, please? Check. Uh, 603,010. So how much is the adjusted present value? How much is the adjusted present value? Someone is asking, what about the interest forgone on the subsidy? What is the meaning of the subsidy? I think that interest that is forgone is the subsidy. That is the subsidy. What is the meaning of the word subsidy? You should ask yourself, what is the meaning of the word subsidy? Is the APV 2477? I see someone has written that. Is the APV 2477.755.725? Someone has written that. And please make sure that you check whether the present value of the subsidy is correct. So can you confirm, please confirm whether that value is correct. Confirm that whether that value is correct. Confirm whether this value is correct, please. And if it is correct, then we can go ahead. If it is correct, we can go ahead. Subsidy. Someone is saying that subsidy is 33. Is the subsidy 33? I don't know where that is coming from. So if that is correct, I want us to go to the past papers, and I want us to look at a question in let me see. There is a question, determine the APV. Yeah, good. Let us look at a question in November 2023. November 2023. Question what? I think it should be question 1. November, question number 1. Let's look at that question. November 2023. Question number 1. Just open that question. Open that question. Can you see my screen? Can you see my screen? I'm displaying question 1, November 2023. Please let me know whether you can see my screen. Please, can you see my screen so that we move together? Okay, if you can see my screen and you have opened the question, I want us to read through the question, and I read question number 1. Instant Power Limited, IPL. Instant Power Limited is a hydroelectric power plant within an importment facility. The company has established a project to build a hydroelectric power plant in Bugesera. The company intends to purchase an initial crucial machine for Rwandan francs 100 million. The machine is expected to operate for 25 years only and get fully depreciated. The company predicts that it will earn earnings before interest and tax and depreciation amounting to Rwandan francs 14 million per annum for 25 years with effect from the end of the first year. The company pays corporate tax at rate at 30%. The company's investor require 12% rate of return for the project under all equity financing, and the pre-tax cost of debt of 9.5% because the extent of grid electricity is limited and mainly concentrated near the capital city. Rwandan francs, 20-year loan at an interest rate of 6% per year. To expand the capacity and meet its normal strategic plan, the government has also allowed the company to repay the principal in a single payment at the end of the loan duration. Burera Investment Limited. Burera Investment Limited is a holding company with 3 subsidiaries including Kivu, Ruhondo, and Ibema. Consider the following 2022 data for the 3 subsidized for the 3 subsidized in table 1. All figures are in Rwandan francs billion except for the price per share. We are told that financial data for Kivu, Ruhondo, and Ihema for 2022, currency in billion on Rwandan francs except for the price per share. We are given the particular Kivu, Ruhondo, and Ihema. There is the sales, earnings before interest and tax, net income. We have the cash, depreciation, interest-bearing debt, total asset, then price per share, shares outstanding, shareholders' equity. The company's management is interested in understanding how the 3 subsidiaries performed financially. MS Lungo Aris, the Chief Finance Officer, that is CEO, the CFO, that CFO, has determined that ratio in table 2 below are sufficient for her to brief senior management. We are given selected enterprise value multiples, particulars, equity multiplier, total turnover asset, profit margin, return on equity, market capitalization, enterprise value, price earnings ratio, multiple, enterprise value, multiple, earnings before interest, tax, depreciation. Then we have capital intensity. Then we are given Mparanga Limited. Mparanga Limited is commonly trading and mining company. It produces metal minerals, energy, and agricultural commodity. The company serves the automotive, steel, power generation, battery manufacturing, and oil sectors globally. The company has recently come under intense security for various ethical issues. Staff have long complained of cases of bullying, harassment, and discrimination taking place one after another, and after reporting, no action is taken. A few months ago, several issues were raised in what seemed like a leaked newspaper article. In the article, it appeared that staff work in poor condition. For instance, staff working in mines have no protection personal equipment. The investigative journalists who reported this accusation claimed that when he visited one of the mines, there were 9 children under the age of 15 working along with other order staff required. A. Using appropriate calculation, estimate the adjusted present value of IPL's proposed investment. Note loud of your calculation of to 2 decimal places, 12 marks. Number B, differentiate between APV and NPV as method of investment appraisal and indicate the circumstances under which APV might be better at evaluating capital investment than NPV. C, using information in the Burera Investment Limited case above, calculate the financial ratios for each of the 3 subsidiaries. Use ratios or multiple in table 2 only. 2, describe these 3 companies from a financial point of view. Your answer must be based on the result from one above. D, identify the ethical issues reported in Mparanga Limited and the likely impact of these issues on the companies if not addressed effectively. So what we do, let us start with the first question. Actually, the first question is using appropriate calculation, estimate the adjusted PD of IPL's proposed investment. Let us start with APV, adjusted present value, but this is on question 1 only, the first company only. Yeah. I want to give you 5 minutes. Read through the question. Read through that question. Read through that question and understand. Read through the question and so that we can look at it together. Read. We can see what would be expected, and briefly I read through it once more. Instant Power Limited. Instant Power Limited IPL is hydroelectric power plant with an impoundment facility. The company has established a project to build a hydroelectric power plant in Bugesera. The company intends to purchase initial crucial machinery at 100 million. The machine is expected to operate for 25 years only and get fully depreciated. IPL predicts that it will earn earnings before interest, tax, and depreciation amounting to 14 million per annum for the 25 years with effect from the end of the first year. The company pays corporate tax rate at 30%. The company's investors require a 12% rate of return for the project. Under all equity financing and pre-tax cost of debt of IPL is 9.5%. Because the extent of the grid electricity is limited and mainly concentrated near the capital city, the government will subsidize the project with 50 with 50 million, 20-year loan at an interest rate of 6% per year. To expand capacity and meet its national strategic plan, the government has also allowed the company to repay the principal in a single payment at the end of the loan duration. The question is, if you go down there, you are told required using appropriate calculation, estimate the adjusted present value of IPL proposed investment. Adjusted present value. Let us go to it. Let's work on it together. Okay. We say that adjusted PV is equal to base case NPV plus present value of interest tax shield plus the present value of subsidy, minus the present value of rotation cost. Let us start with the base case NPV. Assuming that the project is all equity financed, we need to determine the NPV. So what is the initial capital? The initial capital is Rwandan francs 100 million. I don't know whether you can see my screen. Can you see my screen? The working on my screen. Can you see the working on my screen? Please let us confirm that. Is my screen visible? I want us to move together. Okay. I see you can see the screen. Good. If you can see the screen, let us continue. Now, what we are told in this question, if I went back to the question, we are told that the initial capital is 100 million Rwandan francs. The machine is expected to have an economic life of 25 years. We have economic life. The economic life is equal to 25 years. Then we have annual cash flow, the cost of equity. This one, if I went back to the question, where is this? There is somewhere we are given the cost of equity. Did I see? Yeah, we are told that the company pays corporate tax rate of 30%. The company's investors require a 12% rate of return for the project at the all equity financed. So we are saying that at the all equity financed is 12%. This is 12%, if I'm correct. Then we determine the annual cash flows. The annual cash flows. We have the earning before depreciation and taxation. Before depreciation and tax. If I checked from my question, we are told that predict it will earn earnings before interest, tax, and depreciation amounting to 14 million. So this one is 14 million. 14 million less depreciation. We are told that this has 100 million. And it has a salvage value of 0 divided by 25. How much is the depreciation? Unless otherwise stated, We assume the depreciation is on a straight line basis. So how much is the depreciation per annum? How much is the depreciation per annum? Someone has written 40 million. Some others have written 4 million, 4 million, 4 million. So I'll pick the 4 million, 4 million. Like that. Oh, sorry. This is 4 million. Whatever we get here is the earnings before taxation, the earnings before tax. This is 10. Okay. Let me first go to the question. Let me go to the question again. We are told that the machine is expected to operate for 25 years only and get fully depreciated. IPL predict that it will earn earnings before interest, tax, and depreciation. Remember, we assume that the farm is all equity financed, so we don't deduct interest. We don't charge interest because it is assumed to be all equity financed, no debt financing. Then we less tax. Less tax. We are told that the tax rate is 30%. 30%. So we need to charge 3 million. That will give us the earnings after taxation, which should be 7 million. Add back depreciation. You add back depreciation. The depreciation was 4 million. This is the annual cash flow. The annual cash flow, this one is giving me 11, like that. We can also try it this way. Annual cash flows is equal to the 14 million. You multiply by 1 minus 0.3. This one we add depreciation tax shield. The depreciation is 4 million. This one multiplied by the tax rate. Okay, can someone give me annual cash flow is, confirm this, 14 million multiplied by 1 minus 0.3 plus depreciation tax shield. Someone to give me the answer to that one, we see whether it is the same. Someone, how much is it? How much is it? How much? 14 million multiplied by 1 minus 0.3 plus depreciation times tax rate. Are you giving 11 million? 11 million. Yeah, 11 million. You see, the funny thing is, someone calculate and say it is 11 million, then they write down there it is not the same. Then you add. Okay, that is the annual cash flows. The annual cash flows is 11 million. I think we have confirmed that. Can we determine the NPV? The base case NPV is equal to 11 million. We multiply by 1. We multiply by 1 minus 1.12 power negative 25 years. Power negative 25 years. Power negative 25 years. Then from there, you divide by 0.12. That should give us the annual cash flow. annual cash flows. There is no salvage value, so we minus the initial capital. Actually, there is nothing else. We don't have the salvage value. I believe that is the right way to go about it. Can someone give us the NPV here? The NPV, NPV, NPV. How much is the NPV? How much is the NPV? How much is the NPV? Someone says that you have made a mistake on the annual cash flow. So what is the annual cash flow if there is a mistake? There is someone who says that you've made a mistake on the annual cash flow. Please, can I see that? What is the problem? You say that you made a mistake on the annual cash flow. What is the annual cash flow? So whoever says that you have made a mistake on the annual cash flow, please let us know where the problem is. Okay, so I see mostly the NPV is negative. That's what a majority is giving. The majority giving negative 13. I will put negative 13. That's the NPV. Then determine the present value of interest tax shield. The present value of the interest tax shield. So interest is equal to, if we went back to the question, we are told that the company pays corporate tax at 30%. The company investors require 12% rate of return for the project under all equity finance, and the pre-tax cost of debt of 9.5% because the extent of the grid electricity is limited and mainly concentrated near the capital city. The government will subsidize the project with a 50 million 20-year loan at an interest rate of 6% per annum to expand the capacity and meet its national strategic plan. The government has also allowed the company to repay the principal in single payment at the end of the loan duration. So they will give a loan, the government will give a loan of 50 million, but the interest rate is 6%. So the question is we are determining the present value of interest tax shield. The interest, you pay the interest at 6% on the 50 million. That is the interest that they will pay. How much is the interest? How much is 6% of 50 million? Interest, let me get that. How much is 6% of the 50 million? 3 million. Interest is 3 million. So if it is 3 million, let's take the interest to be that. So how much is the interest tax shield? Interest tax shield. Interest tax shield. It is equal to the 3 million we multiply by the tax rate, 30%, and this is equal to how much? Is it 900? I think it is 900,000. Please confirm for me. Confirm for me. 900,000, yes, I think it is 900,000. So that is the interest tax shield. Now we compute the present value of interest tax shield. Now the issue of interest tax shield, we are assuming that when you are not given the interest rate, you assume that when you are not given the risk-free rate, you assume that the interest rate is risk-free. So we'll take 900, we multiply by the discounting factor, 1 minus 1 point. The interest rate in the market is 9%, 0.95. I think it is 9.5. Power negative. Now, note one thing. We are told that this loan is there for 20 years. Is 20 years. So we divide by 0.095 like that. Like that. That will give us the present value of the interest tax shield, considering that the subsidy will be given for 20 years. The loan will be given for 20 years. So they will enjoy the interest for 20 years. How much is the present value of the interest tax shield, please? Someone is giving 7 million? Is it 7 million? The one I see there. 7 million, 77981. Please confirm. Let's confirm that. Let's confirm that. I see some 7 million. Let's see. Let's confirm. Let's confirm whether that is correct. Someone else is giving 9 million. 9 million, 7 million, which is which? Is it 7 or 9? I see 73, 79, 31. That is what you are given by majority. So 79, 31. Then determine the present value of subsidy. The present value of subsidy. the subsidy is equal to, the government is giving the loan at 6%, while the market is 9.5%. So we are supposed to take the 9.5%, 9.5%, we minus the 6%, that is the subsidy, we multiply by 50 million. How much is the subsidy? How much is 3.5% of 50 million? How much is, this is 17,500. Can we confirm? I see a majority says the subsidy is 1750. This one will apply for the period of 20 years. Because the loan is given for 20 years, then we get the present value of subsidy. The present value of the subsidy is equal to that amount we multiply by, open a bracket, 1 minus 1.095 power negative 20 for 20 years, close the bracket, divide by 0.095. How much is the present value of the subsidy? How much is the present value of the subsidy, please? Present value of the subsidy. $15,421. Someone is giving 15,421. Can you confirm whether 15,421 is correct? $15,421.7, I think. Okay, that's correct. So I'll give it like that. We are not given any flotation cost, so we determine the APV. We say that APV is equal to base case NPV. We add present value of interest tax shield plus the present value of the subsidy. The present value of the subsidy, you minus present value of flotation costs. We are not given any information about the flotation costs. So we say that APV is equal to Base case NPV was negative here. It was negative, I think. Yeah, this negative. This one. Then you add the present value of the interest tax yield was positive 7. This one. Then you add the present value of, this was flotation, the present value of the subsidy, if I'm correct. Then you minus 0. You minus 0. So how much is this, please? Give me minus 13 plus 7 plus 15. How much is it, please? How much is it? Let us see. How much is it? Someone is giving 96, 81, 96, 81, 96, 81. Which is which? 96.27. I see a majority giving me 96.27. So we say that adjusted PV is equal to 9627, and we can therefore say that the project is viable since the APV is positive. The APV is positive. The APV is positive. Did I see someone ask a question? Every time on PV of tax shield, we use before tax cost of debt. We use the risk-free rate. We use the risk-free rate. We use the risk-free rate. So the risk-free rate, when the risk-free rate is not given, you assume that the cost of the debt in the market is the risk-free rate. When you look at the methods of determining the cost of equity, we have the capital asset pricing model, we have the Gordon's model, we have the interest adjusted rate, the cost of debt adjusted rate. We adjust the cost of debt. So the cost of debt is assumed to be the risk-free. And someone is asking, did the statement of paying the principal after 20 years just charging? Okay, for every debt that you borrow, you pay. You must pay. All the debt that you borrow, you must pay. Do we include anything on the repayment of the debt? You will have the cash inflow on the debt, you will have the cash outflow when you are paying the debt. So it should not be included in other factors, but when it comes to this one, you don't. I think that is it, and that is what was required or what is expected when it comes to determining the APV. I want us to try and respond to the other part of the question. We try to respond to the other part of the question. What was the other part of the question? That was number A. Number B. B. We are told differentiate between APV and NPV as method of investment appraisal, and indicate the circumstances under which APV might be better at evaluating a capital investment than NPV. I think that one I explained in the notes. Maybe because I just explained today, it is important I take you back to the notes so that you can see what we said. Look at this introduction to APV. The conventional NPV analysis assumes that the financing of a new project will mirror the company existing capital structure. However, this assumption isn't always valid. The APV method is the most appropriate techniques for project appraisal in the following situation. Number one, different financing structure. Number two, subsidized debt. Number three, varying discount rate. Number four, complex tax structure. Number five, the issue to do with the capital allowance and tax shield. I will copy this one. I don't need to give anything different. Then I will use it to respond to that part of the question, just the way it is, like that. Then if I went back again, I don't want to give anything different from what we started with. Let me take it here. The adjusted NPV, the adjusted present value method is a project appraisal techniques used when the conventional NPV approach is inappropriate. While the conventional NPV method discounts all cash flow using the company weighted average cost of capital, the APV method separates the project value from the value of financing side effect. This is the difference, because you are required to first explain the difference between the two. Then you give the circumstances. So I'll start by this part, like that. Then the circumstances under which. So the first statement explains the difference. The second part explains the circumstances, like that. Then we take to the second, the part C. Part C of the question. Using information in the Bunera Investment Limited case above, calculate financial ratios for each of the three subsidiaries. Describe these three companies from financial point of view. Okay, that question is Burera Investment. Where is this Burera thing? The Burera Investment. Yeah, let's go open the question, that part of Burera. There is that part of the question. If I could read, we are told Burera Investment Limited. Burera Investment Limited is a holding company, meaning it is the parent company with three subsidiaries, including Kivu, Ruhondo, and Ihema. Consider the following 2022 data for the three subsidiaries in Table 1. All figures are in Rwandan francs billions, except the price per share. We are given Table 1, financial data for Kivu, Ruhondo, and Ihema for 2022, billion of Rwandan francs, except for the price per share. For each, we are given the sales, earnings before interest and taxes, net income, cash, depreciation, interest, bearing debt, total assets, price per share, then shares outstanding, shareholders equity. The company's management is interested in understanding how the three subsidiaries performed financially. Mr. Rungo, MS Rugo Aris, the CFO, has determined that ratios in Table 2 below are sufficient for her to brief the senior management. Table 2 selected enterprise value multiples. We are told equity multiplier, total asset turnover, profit margin, return on equity, market capitalization. We are given enterprise value, price earnings per share, multiple, enterprise value, earnings before interest and taxes. Then we are given the capital intensity. Then down there, the question is, using the information in the Bunera Investment Limited case, calculate the financial ratios for each of the three subsidiaries. Describe these three companies from a financial point of view. Okay, 2 minutes, read through that question, then we work on it together. Please read through it, read through it.